Good morning. We will pay attention to depreciation when the diminishing balance method is used. The following information is provided on the 30th of June. That is the end of the financial year because they ask you to do the entries at the end of the financial year. The vehicles account have a balance of 780 at the end of the year. The accumulated depreciation is the opening balance that indicates that depreciation must still be written off for the current year, so no depreciation was calculated. Provide for depreciation at 20% on the diminishing balance. That means that we will work out the depreciation every time on the reduced amount, taking the cost price less all the accumulated depreciation until the end of the previous financial year. A new vehicle costing $280,000 was purchased on the 1st of January. This has already been recorded. So that means included in this 750 at the end of the year is the 280,000 that was purchased during the year because it was already recorded. If I subtract the 280,000, the new vehicle, it means that the opening balance was 500,000 rand. The opening balance was 500,000. On the 1st of January, an additional vehicle was purchased for 280 to give us the closing balance of 780,000. The opening accumulated depreciation is 244,000. It's indicated that that is the opening balance. First of all, we will write off depreciation on the old vehicles that we purchased in the previous year. The balance of the old vehicle is 500,000. That is the 780 minus the 280,000. So we have to write off depreciation on 500,000. The accumulated depreciation up to the end of the previous year was 244,000. So we deduct all the accumulated depreciation up to the end of the previous year and calculate 20% on this reduced amount or diminishing amount, because we will only write off for 20% on the diminished amount. That will give us 51,200. On the new asset, we've never written off depreciation before, so we can't subtract accumulated depreciation. So the first year that you buy an asset, you will work it out on cost price for the number of months that you used it in the current year. So this 280,000 was purchased on the 1st of January, so we only used it for 6 months this year, times the 20%, and that will give me 28,000. Although we have more than one vehicle, we will only record the total amount, the 79,200, as one entry in the ledger. The depreciation for the current year we calculated as 79,200. Depreciation is an expense, and expenses increase on the debit side. Accumulated depreciation is my negative asset. A positive asset will have a debit balance. So a negative asset will have a credit balance. And we will credit the accumulated depreciation account so that we can see what is the new accumulated amount after the current year's depreciation was written off. So the vehicles account and the accumulated depreciation forms a unit. The two of them are actually one account, but we will show the positive asset in the vehicle account and how the vehicle is reduced on the credit side of the accumulated depreciation account. We will keep on writing off depreciation every year until the accumulated depreciation on the vehicle on the credit side equals the original cost price. If we look at the information, we will take the opening 500,000 for cost, the opening accumulated depreciation 244, that will be in brackets because it reduces the value of my vehicle, and if I subtract it, I determine the carrying amount. So what was it worth at the beginning of the year? Then during the year we wrote off depreciation for 79,200, and we purchased a new vehicle for 280,000. So if I subtract these two figures from each other, it gives me my total movements during the year. At the end of the year, my closing balance in the vehicles account is 780,000. My closing balance in the accumulated depreciation account is 323,200, and if I subtract that, I get the carrying amount, or what is worth at the end of the year. We can check ourselves. If I take the 256 opening balance and I add the 200,800 to the opening balance, it must give me the same closing balance. Determine whether the cost price or diminishing balance method is used before you calculate depreciation for the current year. The carrying amount equals cost less all the accumulated depreciation. We write off depreciation on any vehicles or assets that was purchased in the previous year for the full 12 months of the current year on the carrying amount. Because it's diminishing balance method, it means that we have to take the cost price less all the accumulated depreciation on this asset until the end of the previous year to determine what is the carrying amount. And on this carrying amount, we will calculate depreciation for 12 months. Then you have to determine how long you used the new asset in the current year. So because you bought the new asset in the current year, you can only write off depreciation for the number of months that you actually used it in the current year. Depreciation is debited because depreciation is an expense that increases on the debit side. The depreciation is a nominal account, and all income and expenses are closed off to the profit and loss account at the end of the financial year. Accumulated depreciation is a negative asset. That means it decreases the value of my asset, and therefore it will have a credit balance because an asset increases on the debit side and decreases on the credit side. The accumulated depreciation will be credited with the amount of depreciation for the current year, so that this accumulated amount can increase every year and accumulate until it is the same as the cost price that we originally paid for the asset. Instead of calling it a diminishing balance method, you can also call it reducing balance, or you can say write-off depreciation on carrying amount, because carrying amount is cost less accumulated depreciation, and diminishing balance is also cost less accumulated depreciation.